The era of financial privacy is ending.
This is the end.
A new global framework is forcing crypto exchanges to report everything to tax authorities. And what's crazy is that most people have no idea that it's even happening.
It's happening.
That's why today we're going to tell you everything you need to know about this secret framework, including where it came from, which countries are implementing it, and just how concerned you should be. My name is Lewis, and you're watching The Coin Bureau. Before we begin though, you need to know that I am not a financial advisor and nothing in this video is financial or investment advice. It's educational content intended to explain a new global crypto tax framework. If you hate taxes as much as I do, then karate chop that like button and let's get going. Now, as crypto's adoption has grown, regulators have started sounding the alarm around things like tax evasion. Many have pushed for stricter oversight of the crypto market, and they've finally got what they wanted. It's called CARF, or CARF, and it would mark the end of privacy in crypto. CARF stands for the Crypto Asset Reporting Framework. In a nutshell, it's a global initiative modeled on the Common Reporting Standard, or CRS, used in traditional banking. For context, CRS requires banks to automatically share information on overseas financial accounts to help combat tax evasion. CARF basically takes the CRS framework and extends it to crypto. In practical terms, CARF requires crypto asset service providers, or CASPs, to report user transaction data to tax authorities. These include centralized exchanges, brokers, and some wallet providers. Some DeFi intermediaries may also be included, but fully decentralized, non-custodial platforms are generally exempt. Put simply, anytime a centralized entity is involved, your transaction data could be reported. So then, what data actually gets reported? Well, CASPs must report user identity and tax details to the appropriate regulator, plus summarize transaction data, including crypto to fiat swaps, crypto to crypto trades, and transfers of crypto assets. The problem is that this information will be connected to your identity because of the KYC process you did to use your CASP. Unsurprisingly, this has become one of the most controversial aspects of the CARF, especially for those who came into crypto expecting privacy. And this begs the question of who's behind the CARF. The answer is the Organization for Economic Cooperation and Development, or OECD. Not surprisingly, the OECD also developed the CRS framework that CARF is based on. For those unfamiliar, the OECD is a global organization made up of 38 of the world's largest economies. Its official goal is to improve economic and social well-being around the world by sharing data and coordinating global policies and regulations, especially around finance. But some would argue that its unofficial goal is to increase financial surveillance and control. Case in point, the stated goal of the CARF is to improve global tax transparency by standardizing how crypto tax data is collected and shared between countries. But as you've probably noticed, that's really just code for collecting more of your data. This means that the CARF functions like a global surveillance system built specifically for crypto. However, it's worth noting that the OECD isn't some elite organization or global government. It can't force countries to do anything. It can only make recommendations. Still, this hasn't stopped 48 jurisdictions from adopting CARF to tax crypto users, including the UK, the EU, and other major countries and jurisdictions. Moreover, the global CARF model integrates well with existing regulations in many countries. For example, it aligns with the travel rule under the EU's MiCA regulation, which mandates crypto platforms to share sender and receiver info. It also fits with the EU's Directive on Administrative Cooperation, or DAC8, which applies CARF-style reporting across member states. So, when will this framework become operational? Well, technically, it already is. The 1st of January 2026 marked the start of this reporting period, meaning platforms must now begin collecting data. However, we should note that the actual reporting and international exchange of this data won't happen until 2027, which isn't really all that far away. Now, the good news is that the CARF will only affect centralized platforms. This means that you can protect yourself from the CARF by keeping your crypto assets in self-custody. And the best way to do that is to use a hardware wallet. Luckily, you can find discounts on some of the best hardware wallets around on the Coin Bureau deals page, where you'll also find exchange sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. Just hit the link in the description below or scan this QR code, which will take you right to the deals page. There, you'll see all of our offers across a range of exchange partners. Then click one of these sign up now buttons, and that should take you right to the deal. Remember though, these deals won't be around forever, so take advantage of them while you still can by using the description below or by scanning on the QR code. But now let's get back to the video. As noted earlier, the CARF has sparked plenty of debate around crypto privacy. And as you'll recall, platforms must now collect KYC data linking your real-world identity to your account. However, the CARF doesn't require directly reporting your wallet address. Instead, your account gets a unique identifier, and it's this ID that's shared with tax authorities. But of course, the end result is still the same. Anyone who touches regulated crypto infrastructure, be that an exchange, on or off ramps, or even some crypto-friendly banks, is getting doxxed. But it doesn't stop there. Pretty much any aspect of crypto that touches on traditional finance is included under the CARF model. So think stablecoin flows, deposits, and withdrawals too. And what's more is that once you interact with a CARF-covered platform, your transaction data and identity isn't just reported to your local government, it's reported to governments worldwide. Now, to be fair, the CARF is designed this way to prevent investors from exploiting offshore tax loopholes. But once your identity is reported, there's no taking it back. That's concerning on its own. But if any data is wrong, like a misreported transaction or incorrect personal info, it can be incredibly hard to fix. And because this information is shared globally, these mistakes could have serious consequences. For instance, a totally innocent person could face unexpected issues around things like visas and financial accounts, or could even face cross-border legal trouble just because they were incorrectly flagged because of CARF rules. And the worst part is that even if the shared data is wrong, it will still look like solid evidence on paper. In other words, it could be incredibly hard to disprove and almost impossible to do without doxing yourself anyways. Another concern relates to insider abuse. In a nutshell, employees and contractors at exchanges and other intermediaries could access personal and transaction data before it's reported to authorities. Without strict internal controls within these platforms, there's a real risk of insiders leaking users' data, or even their own identities for their own personal gain. For instance, insiders could use the data collected from whales to gain a competitive trading advantage, or could abuse this information for blackmail, or worse. Incidentally, similar concerns came up during the rollout of the CRS, with worries about insider abuse and data leaks. And it turns out, those fears weren't unfounded. Several issues unfolded, leading to problems ranging from unauthorized sharing of financial info to full-on identity theft. Yikes. But the biggest concern of all is that the data shared under CARF is being shared with governments, which, to be polite, aren't always that trustworthy. Not only does having so much financial information on a government database make it a prime target for hackers, but there's also the risk of this data being abused by the governments themselves. After all, what's stopping governments from using this data later down the line for things like policing, sanctions, benefit eligibility, and much more besides? This has sparked fears that what we're really seeing is a truly dystopian Big Brother system being rolled out before our very eyes. Keep that in mind for later. Now, by this point, you may be thinking that the easiest way to avoid your personal data being traced is to use a non-KYC platform. And you'd be absolutely right. But there's just one problem though: fiat on-ramping. Even if you use a non-KYC exchange, you'll still need to use a fiat on-ramp, and these almost always require KYC. In other words, you might avoid KYC within the crypto ecosystem, but to actually get money in or out of it, you're going to be identified. If you think you can evade this with privacy coins or protocols, well, think again. Regulators worldwide are increasingly treating privacy tools like mixers, privacy coins, and privacy-focused wallets as high-risk tools for money laundering, sanctions, evasion, and other illicit activities. A prime example of this is with the Tornado Cash saga. For anyone unfamiliar, Tornado Cash is a mixing protocol on Ethereum that uses ZK snark cryptography to basically break up transaction links to shield the sender and receiver data of a transaction. Tornado Cash launched in 2019 and went on to become one of crypto's biggest mixing protocols. However, in 2022, the protocol was sanctioned by the Treasury Department's Office of Foreign Asset Control, or OFAC. Basically, they accused Tornado Cash of allegedly facilitating money laundering, supporting the Lazarus Group, a known Korean hacking collective, and even posing threats to American national security, among other things. The thing is, many critics argue that Tornado Cash itself didn't do anything wrong. After all, it's just open source code, and privacy isn't a crime. In fact, the UN considers it a basic human right. In other words, the issue lies with how people use it, not the protocol itself. That's why the Tornado Cash saga has become one of the most controversial debates in crypto history. But of course, Tornado Cash is just one example. Privacy-focused mixers, coins, and services are constantly under regulatory scrutiny worldwide. Take Samurai Wallet, for instance, a Bitcoin wallet known for its integration of privacy features like Whirlpool and Ricochet. In 2024, the DOJ charged the Samurai Wallet's founders with conspiracy to operate an unlicensed money-transmitting business, alleging the platform facilitated more than $2 billion in unlawful transactions and laundering over $100 million in criminal proceeds. On top of this, peer-to-peer trading platforms are either shrinking or enforcing stricter KYC, while privacy coins like Monero, Zcash, and Dash face repeated delistings and regulatory pressure in multiple jurisdictions. And while decentralized exchanges are partially exempt, this only applies when they meet the right conditions. Specifically, DEXs are only exempt when there's no identifiable operator that has control or influence over the protocol. Now, at this point, we should caveat that KYC isn't inherently bad. In fact, it's necessary. Put simply, KYC isn't designed to track every move you make. Its main goal is to protect market participants from bad actors. Regulators rely on it to prevent money laundering, terrorist financing, sanctioned evasions, and tax evasion, the latter being the main reason CARF was developed. However, many argue that the CARF now goes way beyond its original goal and is now a complete overreach of compliance, and it's not hard to see why. The crypto world is becoming a fully tracked environment. KYC is no longer optional for fiat entry, privacy tools are under attack, and regulator oversight is expanding globally. Protocols and users seeking anonymity are forced to comply with CARF or risk severe penalties. Ironically, though, privacy was also one of the leading narratives of 2025, which proves the demand for privacy-preserving tech isn't going away, even with the threat of increased regulatory scrutiny. Okay, so by now it should be clear that increased surveillance and reporting on centralized KYC-based platforms will likely push users who value privacy or censorship resistance towards alternatives. As a result, more capital could flow to DeFi, self-custody solutions, or privacy-focused protocols. And this isn't just speculation. A survey from August last year found that 42% of respondents would likely increase their usage of privacy-enhancing technologies because of the CARF, while 57% said that they were concerned about government access to transaction data. If this survey is anything to go by, then this means that the demand for privacy-focused projects will likely skyrocket. This could be an incredibly bullish catalyst for cryptos like Monero's XMR, Zcash's ZEC, Dash's, Dash, and a whole range of other privacy coins. Oh, and by the way, you could learn more about these cryptos by checking out the video right over here. It's also worth noting that there's a growing demand for payment rails to become more censorship resistant. One example here could be decentralized stablecoins. Ethereum creator and all-around gigabrain Vitalik Buterin recently named privacy and censorship-resistant stablecoins as priorities for crypto's longevity. In his view, decentralized stablecoins need to have three core features. They should track an index rather than the US dollar, should have a decentralized oracle design, and should, quote, solve the problem that staking yield is competition. Beyond decentralized stablecoins, though, other censorship-resistant rails could include using privacy protocols to shield transaction data from overreaching regulators. This means that tokens belonging to privacy protocols could benefit as well, not just privacy coins. Even though the side effect of the CARF could be bullish for certain sectors of crypto, there are a few caveats. First, as we mentioned earlier, most people using DeFi protocols still need to use fiat ramps, which could be tracked under the CARF. Second, the shift to DeFi probably won't accelerate crypto adoption, at least not in the short term. That's because the user experience of many DeFi protocols can be brutal, especially for newcomers. While most of us are comfortable with setting up a wallet, transferring funds, interacting with smart contracts, and making DeFi transactions, the fact is that this is a lot for anyone to learn early on. If centralized exchanges are too heavily scrutinized and decentralized exchanges are too complex, how can we expect new retail investors to rush to put themselves through that learning curve? That said, CARF is likely to be bullish for DeFi over the medium to long term. In the medium term, more users are likely to turn to DeFi to help safeguard their financial data. Over the long term, CARF will bring greater regulatory clarity, for better or for worse, which will likely boost confidence among both retail and institutional investors, helping to attract new users to the space. So, should we worry about the CARF? Well, there are real concerns that its rollout is just another step in the broader trend of financial surveillance. As you've probably realized already, the fact that your transaction data and your personal identity is being tracked around the world is eerily similar to the likes of CBDCs and digital IDs. Combine this with the gradual elimination of cash, and you start to wonder whether the CARF really is about simple tax reporting or just another method to gain oversight and control. In other words, the CARF could be turning crypto into the very system that crypto was designed to fight against, one that consists of government-surveilled and controlled currencies. Thankfully, people around the world are becoming more increasingly aware of this more dystopian direction, and they are pushing back. A good example of this comes from the UK. As you may have heard, the current government announced plans to roll out mandatory digital IDs last September. Within just a month, a petition opposing the proposal reached almost 3 million signatures, making it one of the most largest petitions in the UK's parliamentary history. At first, the UK government simply dismissed the pushback and closed the petition, but the pressure continued. It wasn't until the 13th January this year that the government finally dropped these plans. The lesson here is that with enough people, we could push back against dystopian technologies. And obviously, the same logic applies to crypto. Even if the CARF is just a part of a broader surveillance state system, the system relies on us complying. And remember, crypto is born of the idea that this very system is broken. After all, who actually benefits from CARF? Not the little guy, that's for sure. Governments stand to gain massively from higher tax compliance and easier enforcement actions, while large exchanges can absorb the market share of smaller exchanges that will struggle with the massively increased compliance cost. And of course, surveillance companies like blockchain analytics firms stand to win in a big way. Meanwhile, the individual retail user being tracked with CARF now face much stricter KYC requirements and far less privacy. But it's not all doom and gloom. And to be completely honest, a framework like CARF was probably long overdue. Yes, there are the privacy concerns raised throughout this video. But equally, the crypto industry will only benefit from tighter regulations around tax avoidance, anti-money laundering, and other forms of illicit activity. Put simply, CARF is paving the way for crypto's legitimacy. And with less flexibility for bad actors, this could reduce things like market manipulation that really plague the crypto market. Not only that, but the more regulated and secure the industry becomes, the more investors will feel comfortable enough to engage with it. In other words, CARF could turn out to be a very bullish development for crypto in the long run. At least, let's hope so, because the alternative is far scarier to think about. But you know what? That is enough tinfoil hattery for one day. I want to know what you think though. Are you concerned about the CARF? Or is there nothing to worry about? Let us know your thoughts in the comments below. Also, if you want to learn more about how the crypto market is being manipulated, well, we have a video that you can check out right over here. And if you're wondering what narratives to watch closely in 2026, well, you could check out that video right over here. Thank you all so much for watching. This is Lewis, and I will see you again in another video.